Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cold Redmond, Washington. Thanks for joining us every weekday after the close, especially here after a long holiday weekend to make sense of these markets. We've talked about choppiness in January, the first week lower, the second week higher. What happens here as we kick off week 3 mid-January? Not great, I would say, is the general way I would describe it. Still sort of chopping around that 4,700 to 4,800 range on the S&P 500. We focused in on that short-term range that we're in. Not really making new all-time highs, kind of stalling out as we retest the all-time high on the S&P, but not really breaking down, right? We are seeing some divergences under the hood. We're seeing breadth conditions that had been overheated starting to alleviate those extended conditions. Today's guest, by the way, Adam Turnquist of LPL Financial, will address a number of those topics. I think really interesting to hear how he's talking about the markets and thinking about these markets for all the advisors there in the LPL network. With that in mind, let's get to the market recap and see how things actually played out through the course of this Tuesday here on the markets. Before we get to that, just a quick comment on a poll that we asked you recently. Which sector do you think performs better over the next 3 months? Offense or defense? We're keeping it simple. Consumer discretionary, the XLY. Consumer staples, the XLP. This is about as close to 50-50 as I could imagine. I think within a room for error, that's about half and half between offense and defense, and I find that absolutely fascinating. Now, this is not a question that we ask super regularly that you can see how the sentiment changes over time, but I'm tempted to do so because if you think about it, I bet in November, December, I would argue, I'm sure people would vote overwhelmingly for offense over defense because that's what the charts really suggested, right? We're sort of in this nice rally phase. So far, just in this early days of January 2024, I think we've had a lot of upside and a lot of downside. Just in this brief period of time, we've seen some stocks surprise to the upside. Some of the mega cap leadership names, growth names come to mind. We've had things that have rolled over, like energy, like some financials this week after earnings. Morgan Stanley is an example, something just completely rolling over. So while offense versus defense has been favoring offense in recent months, it's interesting to me to hear a little more risk-off feel from Final Bar Nation here. So something certainly to think about. That ratio, by the way, is an important one. Today's guest, Adam Turnquist, will take a look at that along with some other charts as well. Let's continue on with our market recap. As I mentioned, kind of a choppy day, but less positive than negative, or I guess more negative than positive, generally speaking. The S&P 500 finished today just below 4766. That's down about 0.4% from Friday's close. And again, Monday, the holiday for Martin Luther King Jr. Day. The Dow down about 0.6%. The NASDAQ Composite down 0.2%. Mid caps and small caps all down as well. And the S&P 600 small cap index down 1%. That chart of small caps is not particularly bullish at the moment, particularly on the short-term time frame. Think about the S&P testing that 4,800 level. The IWM, the Russell 2000 ETF, testing the top end of a major league base going back, I think, at least a year prior. We'll look at that chart here in a moment if we have time for it. But you'll notice that it's kind of stalled out at those previous highs. So a lot of these leading indexes that I think were very, very close to a significant breakout, certainly not following through, and now all of a sudden starting to retrace a little bit off of those highs. Certainly backs into that, or I guess backs up that idea of more of a seasonal, weaker first quarter before we set up for some strength later in the year. Worth noting that the mega cap NASDAQ 100 flat, right, almost in the green. It was briefly in the green earlier today, if I remember right. Yeah, in the morning it was. By the end of the day, it really took a strong rally at the end of the day to get it back to that zero level. The VIX pushing higher, by the way, up over a full point. So the VIX is now just below 14. That's another chart I'm going to make a note, see if we can make time to get to the VIX. We talked about sentiment. I think it was on Thursday's show. We did a segment called Getting Sentimental where we dug into the VIX put-call ratios, survey data. Comment on the VIX was you really would need to see the VIX spike as a way of validating uncertainty and validating fear sort of expanding in the market. 14 to 15 was kind of that level I was looking at. We're almost there, right? Today's sort of pushing to the upside. So potentially a really interesting start to this week here, and especially as we get into the meat of earnings season. Interest rates all pushing higher, right? And the longer end of the curve more than the short end of the curve. The 10-year yield now back above 4%. The long bond yield around 4.3%. 5-year yield around 3.94. So 10-year yield above 4% is an interesting point, right? We were at 5% not too long ago. We went down to around 3, below 4%, down around 3.25%, if I remember right, and then bouncing back higher, now back above 4%. The problem with rising rates is it does not tend to be a good environment for growth stocks. Growth stocks are what have been doing the lion's share of the gain, certainly in 2023, and especially in the fourth quarter. You obviously saw growth stocks leading the way higher. Names like Meta, a lot of technology names, and other growth sectors doing quite well. Higher rates are a less ideal condition for that, right? Rates were coming down quite a bit in the fourth quarter as stocks were going higher. Do we see the opposite? Do we see higher rates and weaker stocks? That's kind of the hints of what I'm seeing here. The dollar, by the way, higher, almost a full percent for the UUP. Looking at the commodity space, the broader commodity complex, the DBC, was down about 0.9%. Gold and silver both down about 1%. Copper higher. Everything else pretty much in the red. A lot of red for natural gas prices, which came down quite a bit. Crude oil prices down another 1%. Crude oil very, very close to breaking out end of last week. Certainly looked like we might be breaking above trendline resistance. Not following through. Today, instead of a nice follow through to the upside, you see further deterioration. Crude oil prices continuing to remain relatively weak, and I would argue that means energy not a particularly great area of the market at the moment. We talked a lot about cryptocurrencies last week. We had Adrian Zadunchik on the show. We were talking about the new Bitcoin ETFs, which ended up being approved toward the end of last week, Thursday into Friday. Bitcoin really didn't push to the upside much further, and this is one of those classic, I think, buy the rumor, sell the news sorts of environments, meaning you buy when there's speculation that something might happen. By the time it actually happens, a lot of those gains have already been priced into the market. Bitcoin has already had an incredible run over the last 12 months. However, it is starting to resume a bit of an uptrend after chopping around a little bit over the weekend. Bitcoin up about 2% today, pushing above 43,300, we'll call it. Ethereum prices just below 2,600. That's up over 3% as well. So keep an eye on those. You sort of had a stalled out sort of lack of follow through after the announcement was confirmed on Friday's session, but now restarting this week after the long holiday weekend, pushing back to the upside. I can't imagine that these new ETFs would not draw in additional capital. The question is, how much of that was already priced in? I think Bitcoin going higher from here tells you that there's more upside that has yet to be priced in as well. Let's talk about the sectors here very briefly. Only one of the 11 S&P sectors finishing the green. That's the technology sector, up about 0.25%. Everything else in the red, and that goes from consumer discretionary and consumer staples, both slightly negative, down to energy down over 2%, utilities, materials, industrials, all down about 1% from Friday's close. Let's go to the daily chart of the S&P 500. We talked about that short-term range between 4,700 and 4,800. I rarely have enough time in a 30-minute show to really dig into the details on a lot of the charts. I try to do the best I can at sort of identifying some key points and then hope that you're able to take what we talk about and use it to augment or enhance your own analysis of these charts. And certainly we'd love if you'd use the Stock Charts platform to do that sort of rigorous technical work. That's a platform I use every day, and I'm quite biased, but a big fan of course. But I would say that on the chart of the S&P 500, I think there's a fractal nature that you want to think about. What I mean by that is multiple timeframes sort of give you a different read. On the short-term tactical time frame, you'll see here in this purple shaded area, the S&P is basically range-bound between 4,700 on the lower end, and that's from a number of lows. That's actually mid-December after we first broke above there. We quickly retested 4,700 before bouncing up, and then 4,800, and that's from late December, also mid-January. That was the peak from last Thursday and Friday. It also, of course, lines up very well with, off the left side of the screen, the 2021 to 2022 high, just above 4,800 as well. So think of this as a big retest of all-time highs on the S&P 500. We reached there in mid-December. Here we are about a month later. We have not broken out. We're sort of still testing that resistance, and now we've confirmed support as well. So this is going to end one of two ways, right? We're not going to stay range-bound between 4,700 and 4,800 probably for much longer. So either we break out to new all-time highs and we break out the hats and we, sound the alarm and things are good, or we break below 4,700 and things all of a sudden feel a lot less ideal, right? It feels more that weakness is overcoming strength. There's a lack of buying power. There's an increase in selling pressure. There's a lack of upside momentum. However you want to describe it, it's basically telling you the momentum that got us to this point has now dissipated, or the buyers have now bought, and there's no one left anecdotally to push the market higher. Now, what does that mean if we do break below 4,700? I would argue that's still a short-term tactical negative pattern. I think the longer term levels you would look at, for me at least, 44.50 was that gap from mid-November. The Qs have a similar gap as well. A lot of individual stocks do as well. In my opinion, 4,600 is the next level. 44.50 is really the main one. As long as we hold that on a pullback, I would think of this as a constructive pullback, resetting before a break to new all-time highs, maybe in the second, third quarter. If we don't hold 44.50, that's where you will hear me talk about a lot deeper downside objectives, right? Talking about 4,100, maybe 3,800, even lower. Because if we're not able to hold support on the way down, that tells you that there is an increasing likelihood that we really have a further deterioration. Now, what's interesting is a lot of things would happen between here and there. Breadth conditions would have to change quite a bit. Momentum pictures would change, a lot of other things. I did post a video on my YouTube channel called Market Misbehavior end of last week, talking about 4 potential scenarios for the S&P 500 and setting the odds on each of those. So if you missed that, make sure you check out that video and help you think a little bit more about this chart of the S&P 500, some of those key levels you may want to pay attention to. I'm going to save this for my discussion with the guest, Adam Turnquist, but we will talk about this momentum divergence, higher prices on weaker momentum. I think that's a concern, not just for the S&P, but some other charts as well. Now let's look at the small cap index, and actually I have a chart right here on my equity market indexes chart list. The IWM is the Russell 2000 ETF. I like to look at this one because it really, in a lot of ways, is a measure of breadth, right? I mean, when conditions are strong, when the market is in a bullish phase, large caps are usually doing fine, but small caps tend to do well. And again, there are certainly times in recent history where the market has rallied without small caps. But I would argue, given the run that a lot of those growthy names have already had in 2023, I would certainly want to see improvement in small caps to be bullish and certainly to be optimistic about much further upside beyond new all-time highs for the S&P 500 and the NASDAQ 100. Now, if you look at this chart here of the IWM, you can see why in mid-December, things looked very encouraging, right? We finally broke out of this range around 195 to 197 on the Russell 2000. That's the August 22 high, the February 23 high, the July 23 high, all right around the same level. We gapped right up there and then pushed higher. And this is why in late December, the market's looking really good from the perspective of this particular chart. Now, we were overbought there as we broke to new highs, which is not uncommon, right, to break out on strong upside momentum. It's actually what usually takes to break to new highs. But look at what's happened in the new year, right? While the S&P is kind of threatening that 4,800 level, pulling back just slightly, the Qs are kind of right up at that level. Small caps have come down quite a bit. The RSI is way down here below 50. Now, the RSI for the S&P 500 is still up in those 60s. The RSI for the Russell 2000 is down in the 40s. So it shows you what a dispersion, I think, or a differentiation you're seeing between the mega cap stocks holding up and the smaller cap, more higher beta, higher risk names coming down. What concerns me about that particular pattern is it is super common at market tops. What happens when a market actually hits an exhaustion point, when a market has had a bullish run and starts to be done with that run, what tends to happen is people go to safe places. They go to safe havens, right? If you're nervous about what might happen, usually sell the risky stuff, but keep the stable stuff, right? You'll still hold a Meta or an AMD or an NVIDIA or an Alphabet because those are big stable names that are probably going to do just fine years from now. But you're probably going to sell that speculative biotech name or that emerging technology name because it's just there's a risk that the market's going to go down. So what happens is the small cap, kind of higher beta, higher risk stuff starts to struggle while the mega cap, more of the blue chip, high quality stuff tends to hold up. And that's kind of the pattern you're seeing right now when the Russell 2000 is selling off aggressively and the S&P 500 is not. This is one of those danger signs I'm seeing right now. And again, it doesn't mean the market's going to go to zero, but it certainly tells me this is not the time necessarily to press the long side when you see the risk on the stuff starting to struggle quite a bit. I also want to talk about interest rates. Of course, the 10-year yield has had quite a lot of movement here recently. The 10-year yield, $TNX on the Stock Charts platform in mid-October was up at 5%. It's so interesting how we hit that, almost to the exact level before coming back down. That for now has been the high water mark, and I misspoke earlier. We didn't get down to 3.25. It got down to around 3.8% on the 10-year yield. That's here in late December, right about there. I knew that didn't sound right as it was coming out of my mouth. I'm like, that's not right. 3.8% is right about here. That's where we bottomed out last month, and now we've bounced a little bit higher. Now, 10-year yield above 4%, all that means is when rates remain a little bit elevated, so if we stay above 4%, if we get back up into 4.5, even higher, I just would say that's not a great environment for growth stocks. That's where growth stocks actually tend to struggle. If rates are going higher, usually ends up being a better sign for value stocks because the growth promise of growth stocks, the emerging growth, the growth trajectory over time is based on the interest rate environment. If rates are going up, it basically means the growth is less attractive now, and as a result, growth stocks tend to struggle. Now, there are times when the market can go up and rates are going higher. It's you only have to look back to 2023 to see an example of that. But I would say, generally speaking, rates going up probably not a great sign for our growth-oriented benchmarks. I want to talk about the VIX. Let's go here. We're going to talk about the VIX chart. Volatility is one of those danger signs, right? When I think about what would tell me that the markets are getting worse, what would tell me that conditions are getting worse and then I need to start getting way more defensive or way more cautious than I've been so far. And to be clear, I'm pretty cautiously minded in terms of the conditions because I don't like the divergences I'm seeing. I don't like the risk-off flavor that you're getting from small caps. I don't like the fact that a lot of individual names, besides a smaller group of names that are breaking to new highs like NVIDIA and AMD, others are struggling quite a bit here and pulling off of those, a retest of the highs. Volatility spiking is one of those warning signs, right? A red flag pops up for me if the VIX, which has been remarkably low for the last 6 months, if it starts to rally higher, right? And if you look at what happened in August of last year when the VIX popped up, or in September, October of last year when the VIX was down in this range and then popped higher, those were in pullback phases, right? That's what a pullback tends to look like because when the market is pulling back, that means usually investors that were buying in this period are either no longer buying, people are taking profits, there's some shorts that are opening up, but all of those things tend to expand volatility. It tends to line up with volatility increasing. So the VIX pushing above 14 or 15 is that level that I'm looking at. As of today, we spiked up quite a bit. We're down in the 12 range, 1250 or so as of Friday. As of today, we're almost just above 14. So we're very close to making a new high for the last 6 weeks. Again, the VIX could go much, much higher than this. So let's be clear. It's not a horrible sign just yet. But one of the things I would look for is the VIX accelerating above 14 or 15. Certainly top of mind for me this week as we watch the earnings season here progress in sort of the beginning of the real first week of earnings. With all of those macro charts in mind, let's look at some of the individual names that are on the move, groups that I think you want to pay attention to. Semiconductors, of course, a bellwether group. And what I mean by that is it's a group that tends to do well in bullish phases, right? Semiconductors are a good group to follow because the impact of semiconductors is felt across industries, right? Everything has a chip in it these days. Most things are connected to an internet. It's the Internet of Things more and more. And so semiconductors are a backbone of the modern economy. When AMD and NVIDIA are going up, that usually means conditions are pretty good. So I'm noting that AMD is up another 8% today. And that's just the latest upswing. Look at the resistance in June. Look at how we basically retested that breakout level in early January. And instead of selling off like we've seen from some other sectors, AMD actually accelerating to the upside. NVIDIA, the largest name in that semiconductor group, huge rally in the first half of 2023, a sideways move for the second half of last year with key resistance right around $500 a share, right around big round number resistance. Look at how after the initial test of 500 in August, we pulled back to 400. After the second test of 500, we pulled back to around 450. After the third test, we pulled back to around 475. So every time we test new highs, we pull back and get a shallower pullback, right? And what that shows you is that buyers are coming in on each one of those dips, thrilled to buy NVIDIA at a little short-term discount below $500 a share. What's happened now is in the last couple of weeks, you've seen NVIDIA finally break above 500 and additional buyers are coming in. We're actually pushing the price above 560 as of today's close. That's up another 3%. Now, when names like NVIDIA are overbought right now, and that usually means a short-term pullback's probably coming at some point, but I would imagine that's probably short-term more than anything. The momentum overall is quite strong. The trend is very positive, and the relative strength is undeniably positive, right? Look, relative strength sideways as NVIDIA is basically the market here in the second half of last year. So far, year to date, you'd be hard-pressed to find something that's done better on a relative basis than a name like NVIDIA, certainly an S&P member doing particularly well. Now, before you go thinking Dave's all bulled up on semiconductors, and again, if I need to be somewhere in equities, I can't imagine I'd find a better place than mega cap semiconductors as a good place to be, just to ride out periods of uncertainty because they're pretty stable and established, and for all the reasons that I mentioned earlier. But note how the XLK, of which both of those two stocks are members, notice how the momentum is getting weaker and weaker. This is the problem for the S&P 500, for the technology sector, for a lot of these leading groups. You're seeing the XLK trying to make a new high, but the momentum much weaker. As a matter of fact, it's been sloping downwards since mid-November, certainly since mid-December. You're seeing higher highs in price, a retest of resistance, but weaker and weaker momentum. That usually indicates a trend in the later stages, and that's what concerns me on some of those growth sectors. Now, there are stocks that are struggling quite a bit, and I would highlight Morgan Stanley as an example of an earnings name. They reported on Friday, if I remember right. Friday was sort of the beginning of earnings season coming into Tuesday, Wednesday, Thursday. A lot of companies reporting earnings this week, but a number of financial stocks kind of to kick it off. It might have been today, actually. I'm sorry, I don't know that. But I do have the stock charts platform in front of me, so why don't I look? They reported today. My bad. After the close today, I want to say Morgan Stanley coming on, maybe before the open, actually. You can see down about 1/3% in the after hours, but today, so what was before the open, down about 4% today, so quite a big drawdown. This is after Morgan Stanley was really threatening previous highs. So we're going to look at the unadjusted data here for a second. Right, so you can see 94 was where we peaked out at the end of December. That's essentially a retest of the July peak. We've stalled out, and then today gapping lower. So one of the things we talked about going into January was when you kick off this Q1 earnings season here in mid-January, and financials are now at the front end of that calendar, this could be a catalyst for these banks to go up dramatically. And you're seeing that on names like Goldman Sachs actually doing okay, not really breaking down, holding up just under 1% today. But names like Morgan Stanley show you the risk of when a company misses earnings or when they talk about an outlook that is getting less optimal, because the price comes down pretty quickly, now testing the 200-day moving average on MS. Folks, that's our market recap for today. I want to make a couple quick announcements before we bring on today's guest, Adam Turnquist. First off, we welcome your questions and your feedback, and the best way to get your questions to us is via email. What are you running into as you're trying to analyze the markets using technical analysis? thefinalbar@stockcharts.com is our email. On X, we are at FinalBarSCTV, so just tag us in a comment there. On our YouTube channel, of course, called Stock Charts TV, just drop a comment below the video that you're watching. We would love to hear from you, especially your questions. We'll hope to answer one of your questions in our next mailbag show. I think it'll be Friday of this week. We'll do another all mailbag episode to answer some of these great questions that we received recently from all of you. Also, to let you know, I will be speaking at the Money Show Virtual Expo. That's actually coming up this week. Today, Tuesday, Wednesday, Thursday, if I remember right. I'm actually speaking tomorrow, Wednesday, around 1 p.m. Eastern. I'm going to talk about 5 New Year's resolutions every investor should make. We're going to talk a little bit about routines, decision-making, chart routines, how you analyze charts, what signals and levels you should be paying attention to, money management tips. Should be a really fun, jam-packed 30-minute discussion, and there are a lot of other great presenters that the Money Show is bringing together for a virtual expo. You can go to stockcharts.com/moneyshow to sign up for that event, and I hope you will enjoy me for my session tomorrow on Wednesday at 1 p.m. Eastern. I want to welcome on today's guest, Adam Turnquist. Adam's the Vice President and Chief Technical Strategist at LPL Financial, coming to us live from the frozen tundra of Green Bay, Wisconsin. Adam, how are you these days? Welcome back to the show.
Hey, thanks for having me. I'm doing good. A little cold here in Green Bay. We're right around 0 with a wind chill advisory and a big snowstorm last week. So got all my snow blowing done, and now I'm just kind of hunkered down looking at charts this week.
Kind of riding out the winter. Let's hope here. It's interesting. I mean, as we've talked about in our market recap, a little choppiness here to begin the week after the long holiday weekend. But overall, January has been, certainly a lot of volatility after a strong November, December. A lot of choppiness more than anything. Before we get to some of your charts, just at a high level, I mean, where are you at as we kick off this year after such strength in the fourth quarter? Are you generally seeing more of the same, or do you have more of a cautious tone kind of kicking off the new year?
I think not a technical term here, but more of a Taylor Swift term. We're looking at champagne problems for the market. As you highlighted, we had this 9-week near record high rally, up 15, 16% off those October lows. Stocks very overbought, sentiment very stretched. And the driver of that was, of course, falling interest rates. They became oversold. So now we have this kind of hangover coming into 2024 as mean reversion takes place. We're seeing a little bit of a pause here in this rally for the S&P 500. And of course, yields bouncing off those lows. But I think when you look at it, you step back, look at the trends, the breadth overall, we're still constructive on this market. We think we'll move higher, albeit it's not going to be at a linear pace that we witnessed since the late October lows.
I'll have to ask our stats department. That may be the first Taylor Swift reference we've had on the show. So thanks for that gift, Adam. If so, let's get to your first chart of the S&P 500. Really, I think backing up what you just mentioned, we've certainly seemed to have stalled out here as we test 4,800. When you look at the chart of the S&P 500, tell us what you see and what you're looking for going forward.
Yeah, so the big line in the sand, of course, is going to be 47.97. So that's going to be the number we're looking to clear. That goes back to the January 3rd, 2022 record high that you're highlighting there. So that's really the make or break moment for the market. You can see this, I'd call it a parabolic move off those October lows. And as you know, parabolic moves generally do not end in a time correction. They generally end in a price correction. And according to the technical analysis books, that is anywhere from 1/3 to 2/3 of the initial move. So there could be some weakness in a pullback here. I think the good thing for investors is that's a pullback you want to be buying. So when we look at support, you have the 20-day moving average, kind of immediate support. I didn't see the close today if we dip below that, but I wouldn't be surprised if we get back into that 4,600 area. There's the 50-day there. That's a major area of support for the market. Of course, that goes back to those July highs. I think buy the dip crowd would be coming back into that market. And as technicians, we're of course looking for divergences. And you can see in the middle panel, we're highlighting RSI, the relative strength index. And that is a pretty good example of a negative divergence. You have price making higher highs and momentum expressed through RSI making lower highs. Now that tells me odds for maybe a bit of a pullback. Again, a price correction versus a time correction is likely. Underneath the surface, breadth still looks pretty good. You have about 3/4 of the S&P above their 200-day moving average. And then when you look at the composition of market breadth, so really who's participating and by how much, it's still cyclicals or offensive sectors that are showing up. It's not defensives that are really, changing the leadership trend. So I think that really helps make the call here for a sustainable bull market.
Yeah, you mentioned, so, you're thinking of a pullback more short term, but long term, we're still okay. I guess chart 2 probably sort of confirms that. This is consumer discretionary versus consumer staples. Talk us through how this informs your thinking.
Yeah, so this is a great chart that I like to look at, just kind of a risk on, risk off chart. And when the ratio chart's moving higher, of course, that's consumer discretionary outperforming staples. So those discretionary items that you're buying versus things that you need on the staple side. So in a bullish economic backdrop, we'll call it, this ratio chart should be moving higher. You can see throughout 2022, it was in a pretty well-defined downtrend. I threw the fan wave principle on there. Enough have time to go through that, but you can see, that third trend line that we reversed was a very good indicator for a reversal to risk on, or that risk appetite was coming back into the market. That coincided with the S&P getting back above its 200-day. And you can see we've been in a rising price channel since that reversal and really no trend change here. So this helps you stick with the narrative, I think, longer term. Getting a little bit of a pullback recently as we got a bit stretched, I would call it, when you compare the two, but holding above support kind of in the middle of that channel. So for now, I still think it's going to be more risk on and more a cyclically driven market versus defensives.
It's interesting when you look at these first two charts, right? The S&P, of course, testing new all-time highs, right? I mean, stalling out a bit, but still pretty good. But you still see offense over defense. And so, that big move to risk off, we really haven't seen. What would you need to see on these first two charts to really think, okay, this is now a very bad market? Is it a break below 4,600? Is it defensive sectors really starting to emerge? Like, what would make you a little more concerned than you are at this point?
Yeah, I think we always like the weight of the evidence approach. That's been ingrained in me since I started using technical analysis. So, of course, we want to see at least a break through 4,600, if not, I would say even the 4,450 mark. That's a 50% retracement of this parabolic move. So that would be more the technical side that I'm looking at. Of course, I'd want to see what's happening in terms of overall market breadth, how many stocks are above their 200-day moving average. And if that starts deteriorating below, call it 50%, that's kind of a rough rule of thumb. If half the index isn't in an uptrend, there's problems underneath the surface. And then, of course, I go to the macro, what's going on with interest rates, what's going on with the dollar. If those have started uptrends again, meaningful uptrends, I would be pretty concerned. And I think this would be more of a deeper pullback we'd have to worry about. But not seeing those or evidence of that at this point.
It's so interesting, given the environment we've talked about, given the choppiness, the uncertainty. There are certain areas of the market showing strength. We've talked about the mega cap growth names like NVIDIA, AMD, semiconductor names, making new highs this week, while other things are not. Biotech is another interesting group. Healthcare, we talked about a little bit on the show last week, showing some of the renewed strength in a number of groups. What draws you to biotech here?
Yeah, so I've been watching biotech for a while, waiting for more evidence of a bottom and confirmation of a breakout here. And this is the NASDAQ Biotech Index that we brought with. And you can see that major area of overhead resistance. We've had several retests of that level, failed, entered a downtrend going into the late fall of 2023, reversed that downtrend, and now we recently just broke out above that area of overhead resistance. Had a little bit of a pullback. Oftentimes that will happen. You get overbought. You kind of check back and retest that prior breakout level. That lines up right around the 20-day moving average. I don't know if we got through that today or not, but looks more like a pullback opportunity. And then if you think about biotech as well on more of the macro front, it is considered longer duration, so it's going to be sensitive to interest rates. As a lot of these companies, they don't generate any cash flow, so they're reliant on the capital markets to basically fund their drug discovery and their drug development. So when interest rates come down, and I think stabilize is going to be the key word here for 2024, that should support the market. And then we did see a lot of M&A activity. That's another catalyst for biotech as we go into 2024. So a lot of new deals getting announced in the space. I think that should provide some support as well. But I think there's some more upside here. And you can see it on the ratio chart as well. We always like to look at the absolute price action and then, of course, the relative price action. So that's biotech versus the S&P 500. And you can see where the inflection point was in terms of that relative trend change right off a major support level. We've seen that inflection and some follow through here, getting through those key moving averages. So it looks like the trend is shifting toward biotech outperformance. A little bit overbought here, seeing the pullback on that RSI indicator on the bottom panel. But again, something I think will be a major trend or a theme for 2024.
It's so interesting and really, really interesting comments on biotech. You mentioned interest rates as well, Adam. When we're thinking about the markets here, I guess one of the reasons, arguably, that the Magnificent Seven kind of mega cap growth stocks working so well, certainly in the fourth quarter, is rates came down so quickly, right? 10-year yield from 5% down to below 4%. Now we're actually seeing the 10-year yield push back just above 4% here today. How important is the 10-year yield now going forward? I think a lot of people sort of, trying to figure out what the trajectory for the Fed is going to mean to them. Is the 10-year yield a key chart, and why?
I think it's going to be a key chart as it was in 2022, 2023. I don't think we need lower yields for equities to work, and that's a misconception. I don't think the 10-year needs to keep falling and we start challenging that kind of 325 support level. I think that would actually be dangerous for stocks because that would really be foreshadowing a recession for the market. So I think consolidation would be a good trend for the 10-year, and we witnessed that if you go back to the fall of 2022, throughout most of the summer of 2023, the 10-year was just kind of stuck in this range, and the market liked that. And when you saw the 10-year breakout above 4%, that's when investors started to get a little more panicked. That's when the actual correlation between yields and stocks turned negative, and that obviously accelerated. So I think the best case scenario for equities would be a sideways 10-year for 2024. And I do think in terms of resistance, if we get through the 200-day moving average here, there's going to be a lot of overhead resistance for yields kind of in this 425, call it 435 area of overhead resistance. So that's going to be a key level to watch for the 10-year.
Really interesting and great points there about 2023. A lot of people think rates need to do a certain thing for stocks to work or not work. There have been times when markets have done just fine with rates remaining remarkably low. We only have about a minute left, Adam, but I'd love to ask you about energy Energy is one area of the market that's been lagging behind significantly. You're starting to see energy stocks potentially bounce, but oil prices still remain sort of lower. How do you think about a space like that that's been underperforming? Is there an opportunity there, or what would you need to see to get more interested in an area like energy?
We're actually overweight energy. So we have two sector overweights for comm services and energy. Of course, energy's been a tough one to stomach, just given the relative underperformance here. And when you look at the sector, we've had this little bit of a relief rally, fail at overhead resistance, and now it's coming back and retesting I think the December lows here. And then, of course, on the relative side, that's what, as asset allocators, we're always trying to outperform and find sectors that are outperforming, and that's been a disappointment as well. We are near a very, very key area of support for that ratio chart, so I've been watching that carefully. And then just overall breadth was within the sector. It has deteriorated a little bit, and there's always a but, with crude oil is looking a little bit more constructive here. We've seen a few higher lows come in. Still has a lot more work to do in terms of overhead resistance, but the fact is that we're not making new lows. We kind of held this, call it $64 to $68 range of support. I think that was the lows. I think OPEC Plus really provided the support down there. And now we're waiting for a catalyst to break out. And I think that's going to be China, if and when we get some type of major stimulus package from China or any type of confidence in their recovery.
Really touched on a lot of interesting points there. Thanks for sharing some technical insights, some other macro thoughts as well, Adam. Great to see you. Welcome back to the show. Happy New Year. Stay warm there in Green Bay, and we'll talk to you later.
All right. Thanks a lot. Take care.
Great take there from Adam Turnquist at LPL Financial. I love how he's thinking about sort of the relationship between the short term and the long term, right? If you heard what he was talking about with these short term conditions, right? Talking about it being a tactical pullback, probably a buying opportunity. So some of the things that I generally heard from the comments that Adam was making, but long term, the structure's still sound. And I think one of the great benefits of technical analysis, hopefully the Stock Charts platform for you, is the ability to think about those different timeframes, not get too caught up into one day's action or one particular tactical move, but more of the bigger picture, those ratio charts, looking at relative performance of a sector versus a benchmark, looking at consumer discretionary versus consumer staples, offense over defense. Those are some of the things that really help you understand the longer term trajectory of risk on versus risk off. Great take there, as always, by Adam Turnquist at LPL Financial. Folks, you've got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We're keeping it simple, and again, hopefully you've seen, if you've watched the show for a while, my goal in life as a technical analyst is to simplify. I want people to understand the markets a little better than they did before looking at some of our comments, and I also want them to recognize that some simple trend analysis can really put you on the right side of things more often than you might expect. Thinking of the S&P 500, I'm always concerned when I see any market making higher highs on weaker momentum, and I would say what's happened from mid-December to mid-January is an exaggerated form of a bearish divergence. My guest today, Adam Turnquist, talked about this bearish divergence with the S&P making new highs and certainly attempting to make new highs above 4,800 on weaker momentum, right? The RSI down, below 60 today after being above 80 in mid-December on that first attempt to get above 4,800. We talked earlier about the technology sector during our market recap, the XLK having a similar pattern and stocks moving higher in a number of sectors, but on weaker momentum. Watch for that momentum divergence. It's not 100% accurate. It doesn't mean that every time you see that there's definitely a high, but it really is pretty common at bull market tops. And that is one of those things that gets me a little uncomfortable about upside, or a little less confident in upside potential here in Q1. Chart number 2, looking at breadth, I would agree 100% with Adam Turnquist's comments about breadth indicators. He was actually referring to this series here, which is the percent of stocks above their 200-day moving average. It peaked around 80% at the end of last year, down to around 73%. And I would agree, right? We're well above 50%, which tells you long-term things are still fine, right? Even if we pull back quite a bit, as long as stocks hold their 200-day moving average, conditions are probably not getting too bad. And if you think about it, on the S&P, that's from 4760 down to 4,400. That's quite a range. That's quite a big move to remain above its 200-day moving average. And that is the space that a market that has had a really good run can have and still be considered a bullish trend. And that's what you have to remember. The indicator I'm looking at right now, though, is this bottom series, which is the percent of S&P stocks above their 50-day, which concerns me on this tactical time frame as we've stalled out in our attempts to get above 4,800. The breadth conditions now starting to turn lower. Now, again, it's still 8 out of every 10 S&P stocks above their 50-day, but it's down quite a bit, right? About 10% of the S&P have now broken below their 50% just in the last week or two. And that is what is starting to happen that is making this look a lot like some of the other sort of major market peaks that we've experienced over the last 18 months for the S&P 500. Now, to be clear, it is not all bad. And chart number three highlights some of those names that are breaking out. We talked about mega cap semiconductor names, AMD making new 52-week highs today, NVIDIA making a new 52-week high today. There are stocks making new 52-week highs. So when you ask me in this sort of environment, what should I invest in, right? Where should I be? I think there are two general ways to think about it. Number one, think about what should work because of the market conditions. All right, rates might be going up, the market's going risk off. So what things tend to do well, or based on seasonality, what has tended to work? I don't disagree with that, but I would much rather go with the second option, which is invest in what's working. As always, lean into what's working, lean away from what's not working. That is the essence of what's called momentum investing. That's the essence of what we call trend following, and that is the essence of where I think charts can really help you. It doesn't matter what the market thinks AMD should do. If the price is going up, I'm going to want to own things that are doing well, particularly on a relative basis. Here are two stocks making new highs, even while the market is unable to do so. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. Special thank you to Adam Turnquist of LPL Financial joining us from Green Bay, Wisconsin. Don't forget to like this video, subscribe to our channel while you're here. We would so appreciate it. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.